Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Mike Zlotnik. Mike is also known as Big Mike. He is the CEO of TF Management Group, LLC. It's a full-time real estate fund manager and has been since 2009. He is a passive investor since 2000. Mike has decades of experience navigating multiple market cycles and structuring funds that deliver strong risk-adjusted returns. He is the host of the Big Mike Fund podcast and the author of How to Choose a Smart Real Estate Investment Fund. He has a background in mathematics and IT. Mike combines data-driven analysis with strategic insight to help investors build long-term, tax-efficient wealth through real estate. Mike, welcome to The Wealth Flow.
Thank you, Keith. Appreciate that long introduction. Appreciate you having me.
No problem. The font was a little small as I was reading it, so sorry at the beginning there. It took a minute. At any rate, I love to just start with really your background, where you grew up and what eventually led you into this world of real estate and real estate investing.
Yeah. There's an old James Bond movie called From Russia with Love. I come not from Russia, although my native tongue is Russian. I come from Moldova. I actually left in 1989. It was still USSR, former USSR. So I left and I came to the United States. I became U.S. Actually as a political refugee from the communist Soviet Union. I'm a U.S. citizen. I'm a U.S. patriot today, and it's been a journey here in the United States. So originally from Moldova, I grew up actually being a mathematician, math geek, and a chess geek. I grew up literally playing chess. I hit my 10,000 hours in chess probably by the age of 14. I was literally playing chess from 4 years of age, at least 20 hours a week. So that's my childhood. 89, come to the States, have lived pretty much all my life in the U.S. in the state of New York, upstate New York, Rochester, New York. I went to school in Binghamton, New York. And then I've lived in New York City with my family since 1996. So I'm in Brooklyn for many, many years. And IT. So I spent almost 15 years in technology, being a mathematician, studying computer science, mathematics. Guess what I did after college? Computer science, all that fun stuff, IT. I had an almost 15-year career. I really loved it and enjoyed it. And I still have many friends in that world. But I was a little bit, I don't want to call it burned out. I was ready to switch and do something else in my life in 2009. I discovered real estate passively in 2000. Literally buying my first apartment in Brooklyn and then buying other apartments and some houses, multifamily houses in Brooklyn. So I discovered passive investing and I realized this is a lot more predictable, easier to understand, simpler. IT moves fast and always moved fast and you have to stay on your toes all the time. And as even though I had a very successful career, I really enjoyed it. But it was almost 24/7 in real estate. You can actually sleep at night. You could make money work for you at night. So I switched 2009 at the first opportunity. When I was done with IT, I was burnt out. My last gig in IT was done. And then I went real estate full time, literally never looked back, kind of my area of passion. And that's it. That's how the journey started. And been running real estate funds on syndications, deals since, for many years now.
Very interesting. And so, how did you find out about just being a passive investor in apartments? It was through a friend, or what led you to even know about that? Because one of the things I find is that there's so many people out there that just don't know that that's even a possibility that you could, put money into as a limited partner into a apartment, for instance.
So I'll give you my story. Very, very straightforward. So I buy my first apartment. I get married in 1999. And we have to buy an apartment with my wife. First place to live till we get married. And we live in a rental apartment and started looking for a place. We find a place in Brooklyn, in the area where we were looking. Her mom lived 3 minutes away. Her sisters lived 5 minutes away. So it was all very, very close. We had a specific need to live near family. We're very close. So we find an apartment. It's a co-op apartment. Co-op is a form of, it's like a condo, but it's just a little different structure. In New York City, co-op and condos are very, very common. Both are very, very similar. A little different, but they're similar. So we find a first apartment, and we buy it for cash. Savings I had through my work, and coincidentally, I bought the apartment from a retiring president of a co-op association, and he retired, and then there was new elections, and I ran. I just bought the apartment, I ran, and I got on the board very quickly. It was a whole bunch of old people don't want to do anything. I was the young guy and I full energy, so I get on the board, I buy my first apartment, live in a building. Before I know, talking about some of the stuff just happens. Before I know, I get a phone call from a really old guy, says, you got to come over to my house, and I own a few apartments in the building. So the guy calls me over. And he says, listen, I'm old. I'm 85-year-old. I don't need the money. I have one son. He's an incredibly successful lawyer. I'm very tired. Here's 8 apartments. Do you want to buy them? Because I'm done. I'm tired. And I appreciate the offer. I stepped away. I said, listen, I got to come back. I got to a little bit think about it. And I asked him, of course, how much he wants for the apartment. He gave me a reasonable offer. And I thought about this, and I said, it's not a bad deal already. But I don't have the cash. How do I do this? So I stepped away. I called my sister, said, I got a great deal. Do you have the cash? Can we figure it out? And she says, yeah, if it's a great deal, yeah, I'll scrap the cash and we'll buy those 8 apartments. It's kind of crazy how it works.
Yeah.
And I come back, but before I go there, I buy a jar of honey. This was very, very important. He's an old guy, was a nice, sweet fellow. I buy a jar of honey. I bring him the jar of honey. And I tell him, listen, I really appreciate you. You're such a wonderful person. And I said, I would love to pay you your price, but I negotiate a little bit, but I let the honey negotiate. It's kind of the jar of honey did the negotiation for me. He was very, we had tea with honey.
Yeah.
Long story short, he gave me even much sweeter deal. It didn't even matter to him. He was such an old guy. He was tired. He didn't need the money. It was almost like he bought them, I don't know, many, many years ago. So long story short, a jar of honey that got me about $160,000 discount off the price he was asking for, already a good price. So I'm writing a new book, and I'm putting the story in the book how a jar of honey is worth $160,000.
Yeah. No, I love it. It is funny how these real estate deals will work. When it's, especially when it's an individual that you're dealing with, and we do a lot of that with mom and pop type operators, where you lose some of that. I think a little, possibly. There's still ways to do it through a broker, but you lose a little bit of that going through broker. But to deal directly with an individual, it's amazing what a jar of honey will do.
How you get a deal. You have to connect. You have to somehow feel them good and happy, understand their motivations. I've spent many years in the multiple mastermind groups, and I know a lot of residential investors who buy these, houses and apartments. I do mostly commercial nowadays, but on a residential level, you can establish this connection. Of course, you don't want to deal through a broker intermediary. Ultimately, you want to get to the owner and understand their motivation. This is how you get the best deals. And in commercial, it happens too. Same thing happens. You just got to understand the motivation of a seller. Is it a life event? Is it a financial pressure? Is this, what's driving the transaction? And if you're looking for a deal, there's always a motivated seller or distressed seller or some, and it's not necessarily a negative play. It's how the market works. Somebody needs to sell. You're looking to buy. And there's a good old expression: make the money in the buy real estate. That's one of the best advantages in real estate. You can actually make the money on the buy by getting the right deal at the right price at the right time with the right motivation. That's it. That's the story. So this is how I got started and never looked back. Bought more houses, apartments, look for motivation. And in commercial space, it's very true today. We're finding deals where there's significant motivation for whatever reason. And this has scalability. Now, commercial, of course, you're negotiating with sophisticated owners, you're negotiating with sophisticated brokers. So it's a little bit different, but motivation is motivation. If you get to it, you can figure out, can you make a deal or not? And if not,
for sure.
walk away. Go look for the next deal.
Absolutely. So you bought this first apartment building as a co-op in an apartment complex, and that led you to 8 more.
Well, the 8 happened. Yeah, 8 happened in one transaction, and I kept buying more over time. And some I flipped, some of them, some I kept, and then when I say multifamily houses, is not 80 doors in like 3-family house in Brooklyn, just as an example. And then I continued to get into essentially 2009. There was a GFS, Great Financial Crisis, the market reset. Now, not New York City, but in other parts of the country. And this is when I went full time, is when the market was basically full of short sales. It's just the market was a lot of distress, a lot of difficulties for banks, and the opportunity became immense. Like literally, there was a massive opportunity and a lot of wealth was created after that. So after the market resets, and the market reset for whatever reason, loose credit, loose liquidity, prices were through the roof. When the market reset, properties were trading in some cases, 30 cents on a dollar, 40 cents on a dollar. And financing was needed. And originally how Tempo Funding was started was a good friend of mine from IT years. He basically started funding short sale flips, but he didn't want to do it full time. He just turned it over to me. He said, Mike, I started a company called TempoFunding.com. We're funding short sale flips. So what the hell was a short sale flip? Well, somebody would get, house used to be worth $1 million. Now it was worth, let's call it $400,000. And the owner, and the mortgage was upside down, $600,000, $700,000. The mortgage was much greater than the balance, the price on the market today. And long story short, people could negotiate, hey, I'll buy the house for $350 from the bank. Well, they buy it from the owner with a bank approval. And the banks were doing drive-by BPOs. They were often very wrong in the values. The values were off by so much, you couldn't tell, is this worth $500,000, $400,000, $350? These drive-by BPOs were often wrong, and people got an immense deals. And then they would flip the house. They buy it for $350. They'll flip it for $400, make $50K profit on a flip. The house would appraise for $450, $500. Somebody would get a good deal to live in the house. So long story short, these short sale flips is how we entered the market. We gave loans for sometimes 1 day, 2 days, 3 days. And then sometimes they had to be held for 30 days. So we got into this private credit short sale funding in 2009, and then we never looked back over the years.
Okay. Is that still, do you still have, is that still part of your business model on the fund, is kind of providing that short-term financing, or what is that, how has that changed, I guess, your focus?
So we still provide what is known as hard money loans. The typical term is private credit. It's the same thing. It's just basically you're loaning the money against the property. initially we were loaning the money for a very short amount of time. These flips were very, very short. Sometimes same day. Literally, people would buy the house 10 o'clock in the morning and sell it at 2 o'clock. So they would have what we call it purchase and sale contract, A to B contract, and then B to C sale of the property. That business was, from a funding perspective, was insane returns because you funded, you got 2 points for 1 day. Sometimes it took 2 days, 3 days. Then banks started putting anti-flip restrictions, and we started to fund it for 30-day hold, 60-day hold, 90-day hold, 120-day hold. We do that funding today. So we basically will do a bridge loan. You want to buy a house, do fix and flip. You could if you get a good price and you can just flip it, great. If you want to rehab it, you're welcome to do that. That's been kind of bread and butter for many years. We still do it. Literally, this is still part of what we do, the hard money loans. But we also do a lot more commercial deals and other opportunities. So that business exists today. It's essentially loans, duration under 12 months. Most of these projects go through the full cycle within 6 months. Purchase, quick rehab, sell. If you bought it right, 6 months should be enough. 6-9 months. So that's just a very traditional business, and it's a simple business. It's a simple business. You get high yield. That's what people call it, private credit, as I said. So that's it.
Yeah. Talk about a little bit on that side of the business, and then I definitely want to hear about some of the other stuff you're doing from an investor standpoint. You're doing this. It sounds like now in a more of a fund type structure where you've got outside investors that are saying they're putting money with you as part of the fund. You guys are receiving these opportunities to basically be able to provide short-term financing for opportunities like fix and flips, that kind of thing. What are you doing from a risk standpoint to try to assure that these are deals that hit each and every time? From a loan to value standpoint, what kind of return from an interest rate standpoint are these investors that are using your money typically paying? I guess talk a little bit about some of those dynamics.
Yeah, sure. So this stuff is incredibly basic, and hard money underwriting is not that difficult. In fact, you could, and the business we've done over the years is generally with the same people again and again and again. We don't market. We don't take on essentially new clients. Everything is on referral. And we have people who, I don't know, I have lost track of how many deals they've done. Many, many, many dozens. Sometimes maybe, we have some clients, call them, 100 deals plus, right?
Yeah.
So they just do the same thing again and again and again. So what we charge today, when the rates were low, we got down to 12% interest rate and, 2 to 3 points. Today, we still charge the same 2 to 3 points. The interest rate we charge today is 14%. Interest rates have gone up a little bit, right, with the Fed pushing rates. It's not the cheapest money out there. There are some larger institutional lenders. You could get, 10, 11, 12% rates in this environment. And when the rates were lower, they were sub 10%. People were getting money at, 8, 9, 10%. That's private credit. It's a classic private credit. 2 to 3 points, some level of a yield. And from underwriting perspective, fairly straightforward, right? So first you underwrite the jockey. And by the way, this applies to any investments we do in commercial real estate, equity or debt. So you first underwrite jockey, head of the horse. So the horse is the deal, the jockey is who you're investing with. And you try to understand them over the years, their character. You could do background checks, you can do credit checks, you can do some basic things. Like we're doing a commercial deal now, we're running background checks and litigation check on the principals, right? These basic things you can do if you're looking to do, one-off deals. Now, there's a process to this. There's a process to this madness, but it's not that difficult. And then you look at the value of the property. There are all kinds of desktop appraisal tools. It's not that difficult to establish a value today. Of course, condition matters. So you could send inspectors over. You don't have to go to the property to check it out. You could send an inspector, take pictures, understand what condition it's in. Many of these projects come to us, hey, I'm buying the property for $150,000. It needs $50,000 rehab. They'll send you a list of items. They'll send you, pictures, and you go through the process and you understand what they're going to do, and then they're going to sell the property, cost basis $200,000, with the purchase and construction and sale price for 300. Okay, there's plenty of margin. And you look at the LTV on your loan. Traditional hard money LTV is 65% in the post-repair value. In some cases, you push it to 70. It's a function of your own comfort level, who is the borrower, et cetera, et cetera. But these are fairly straightforward conditions, and you go through the process. It's not a difficult process. So for those people who want to do it locally with their own investors, they can do it. They can write a check into a fund, and the fund manager runs a portfolio of these type of loans. So that's the real foundation of the hard money lending business.
Yeah. And there's so many people out there that are doing it. When you look at a lot of investors, typically you'll see people start out and, everybody's path is different, right? But a lot of investors, they'll start out, they're doing some type of wholesaling, and then they start to get into flipping. And, this type of financing that you're providing is sort of the backbone for that. It really, it doesn't go away. It's always out there. Good times, bad times, doesn't matter the cycle. There's always people transacting and doing this business. So, it's really a great, a great type of investment for sure.
Yeah, it's a simple yield play. I mean, it doesn't build wealth. It gets yield. It's a stable, predictable, cash flowing type of business. There are plenty of other opportunities, and let's kind of move forward. Maybe switch. I could talk a little bit about other things that we do.
Yeah.
But this is like a bread and butter, meat and potatoes of passive investing. If you're an active investor, you may need this to do your deals. If you're a passive investor, this is something worth considering to participate in because of predictability, stability of, and as a fund manager, of course, you deal with the difficult file here and there. There's some problem situation, but you set aside loss reserves and you basically manage it on a portfolio basis. So if you do enough of them, you do them at the right appraisals, and when the market is either rising or stable, you're in good shape. If the market is contracting and the prices are falling, then you got to tighten up your underwriting and make sure that these deals have a margin of safety, in a matter of speaking. But going beyond that, there's plenty of other really predictable opportunities in real estate if you're looking for passive income. I don't know if this is the right time to switch and talk a little bit about. I can just kind of mention.
Yeah, for sure. That'd be great.
Like we're doing now an absolute triple net industrial deal, just as an example. And just for audience, so folks can understand what is an absolute triple net industrial. And I'll add two more words, kind of funny. They sound a little interesting. It's called sale-leaseback absolute triple net industrial. There's so many things I just mentioned, but they are very. We have a renaissance of industrial coming back, made in America, back to made in the USA. A lot of industrial production is happening here. So there's a long-term welcome for these industrial investments. So businesses and real estate assets that work in conjunction to produce in America make a lot of sense. So that's why we love industrial asset class. Two, sale-leaseback is just a niche transaction where a private equity company buys an established business that does industrial production. In the case we're working on, it's a steel manufacturer in Midwest. And what happens is private equity buys it, and they don't want to own real estate. They just want to own the business. They get a better return on business than on real estate. And then they sell real estate. They want to sell real estate, but they don't want to move the business. So they do an immediate sale and lease back. So what happens is they effectively keep the location. They monetize their real estate, they get the cash out, and then they sign 20, 25-year, very, very predictable lease. So you, as the buyer of real estate or investor into that deal, what do you get? You own a piece of real estate with an immediate lease. You don't have to go find a tenant. And the lease is typically multi-year lease. Now, you have to underwrite that company, but if the company has been there for 60 years and continues to do well, and now they have a corporate backer with a lot more capital, the underwriting usually is not a difficult process. And you look, okay, you have a 25-year lease, very stable tenant, and what happens with cost increases? This is where triple net comes in, where taxes go up, insurance goes up. It needs a new roof. It needs a new pavement. The tenant agrees as part of the lease to pay for everything. They basically eat all those costs. And then you as the owner get an annual rent escalation clause. Typically it's 2 to 3%. The deal we're doing is 2.75%. Every year your rent goes up 2.75%. It gets all immediately added to NOI. So NOI is growing very predictably. So it feels like private credit, but it's not, it's equity. But it's so predictable. And typically you leverage an investment like this with fixed rate debt, and you leverage it with conservative leverage like 65%. So what do you get? And is another example for those people who understand cap rates. And I'm going to mention cap rates and explain it in a simple manner. So what is a cap rate? Cap rate is used often in commercial real estate, but it applies in residential too. So when you buy a property for cash, when I bought those apartments, I bought them for cash. And you get a return after expenses, you get a yield. After your rent collected minus your costs, your taxes, your insurance, your operating costs, that profit, that NOI, without any mortgage leverage, that's your cap rate. So if you have a 6% cash-on-cash return, that's a 6% cap rate because it's done purely without mortgage computation. So in this particular deal, industrial deal, it's being acquired at the going-in cap rate without any mortgage leverage at 8.6%. And there's a 65% mortgage leverage in this deal, but the mortgage is at 6.3, right around 6.3%, plus minus a little bit because it's just as an example. So you have a positive spread between the capitalization rate, which you collect cash on cash if there was no mortgage, and then you leverage with the cost of money below that. That positive spread is a margin of safety. Like today we love 2% of margin of safety. This is more than 2%. So just give you an example how we look at a deal, how you can get steady, predictable income, similar to what you would get in a private credit fund. So private credit fund, we talked about this. It's hard money lending, right? You can get 9 to 11% plus minus a little bit, sometimes 10 to 12. But that's the yield on the hard money, and that's what investors would get in a passive fund. If you go now into absolute triple net, you can get a yield, let's call it 7, 8, sometimes even more percent. And then you get your return typically mid to high teens, very, very predictably through those rent escalation clauses. As the NOI goes up, so does the value, even if nothing happens to the interest rate. So this is a classic example of a very stable, predictable way to get cash flow from day one and a predictable appreciation. Why I compare and contrast that to private credit? Because both of them, from a credit risk perspective or from a risk perspective as an investment, they're on a very similar level of risk, except for private credit, you get your, let's call it 9 to 11. And then in the triple net industrial, you can get 15, 16, et cetera, percent IRR, which is a little bit, every channel is a little bit higher. Not sure, I don't want to go into IRR computation, but IRR is a internal rate of return. And if you get 15% IRR, it generally means your average channel will be somewhat higher than that. So it's just how the math works.
WealthFlow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. Tell me a little bit more on those type of industrial, where you're getting these 20-year leases, and it's a, like you said, it's a leaseback. So essentially, the business that's been there operating, that owned it prior to, say, private equity coming in and purchasing it, now has decided that they want to liquidate the real estate piece of it to get an immediate return coming out of it, and that they don't care to own that real estate. Gives kind of I don't know if they give the cash back to the investors, whatever it may be. Maybe it's just profits right off the bat, but that now they're leasing it at this point. You know this coming in. This is an opportunity where you get those 2.75%, 3% rent bumps every year. How long are you typically holding that investment for before the fund sells it?
Yeah, it's a great question. So in general, we're not in the business of owning it for 20, 25 years. Way low. So most of these deals underwritten for a 5-year hold. That's simple.
Yeah. Okay.
Can it take 6? Yes. Could it terminate in 4 if it's the right time to sell? Yes. So the 5% time frame is more or less very, very predictable. But the beauty about this is you have a 25-year lease. You can sell it to the next buyer with another 20 years left on the lease. So you're not selling it, like if you have a fresh lease for 25 years, you're not selling something maturing very, very soon. That's why I love these long maturity leases. It's kind of like this. When you go look at the commercial real estate, I'm just going to give you this perspective. The longest term leases you see are typically these long industrial leases, 20, 25-year leases. Then you go into some, shopping center leases. They could be 10, 15-year leases. Then you go into the multifamily, where, it's apartment complex. And they year to year, right? You can get 2-year lease or 1-year lease that typically are annual. And then the shortest of them all is self-storage, just month to month. So everything is a beauty and a curse, right? So if you're on self-storage and the demand is booming, you could bump up rents next month. This is how funny it is. But if the market is overbuilt, today we see some markets, they overbuilt, REITs overbuilt these facilities, and the rents are falling, and they are giving concessions just to get the folks in, right? So self-storage is much more volatile because it's month to month. You have less predictability, you have more theoretically upside if times are good, but if times are not good, or asset gets, competing property gets built within 2 miles or 3 miles away, it's immediate competition and you can't grow demand in storage, as an example. Multifamily, same issue. You could overbuild. Some markets, you've seen negative rent growth because you overbuilt, and it takes multiple years of absorption to remove that oversupply, absorb the supply. So what we see in open-air shopping and industrial, we love them because of much longer lease time and predictability. Now, of course, if it's severe recession, you could say, hey, your retail tenants could leave. They could. So open-air shopping is a little bit more risk, but you get a little more returns than industrial. But industrial, most of these tenants, especially, domestic manufacturing, linked to these long-term industrial businesses, they're much more stable. They've been around for a long time. They're going to continue to be there for a long time. And these leases have high stability. It's kind of amazing what I see, the failure rates. Statistically, they're way less than 1% in these industrial spaces, at least what we have seen. So you could do 100 deals and 99 and a half, let's just call it. They're producing cash flow very, very predictably. And once in a while, you have one of those situations where the tenant's business is collapsing and then you got to go find another tenant. But if you bought the property right, yes, it might be, work to find a new tenant and release the asset. But overall, they're so stable. That's why we love it. It's just and the reason I wanted to give you other perspectives is because commercial real estate has kind of all kinds of opportunities, right? You have even senior living facility, you have car washes, you have self-storage facilities. Some of them are more operating businesses. They're really, property management means a lot. Multifamily property management means a lot. You have to operate well. You go to long-term shopping centers, open air especially, they're more predictable, less work. And then you go to industrial, there's almost no property management because of an absolute triple net. You literally are an investor with the bond that's paying you, and then every year that bond coupon is increasing. And then on sale, you get a big appreciation because the NOI grew and people are willing to pay more to the next investor for the same bond. It's not a bond technically, it's equity, but its predictability is very high. So I just wanted to differentiate so people understand kind of Yeah, you could have target returns in the 20s on a multifamily project, but it's a lot of work. And, if there's rent regulation, if difficulty rehabbing, COVID hits or some other issues hit, complexity goes through the roof. Storage, somebody builds a competing facility, all kinds of problems with supply, right? With
That's
those
right.
industrial projects, it's a lot more predictable.
No, I think that's a great distinction. It really is. And you look at it as well. If an apartment building, for instance, if something happens to the roof, to the plumbing, to whatever, there's an issue. Roof in particular, and taxes in particular. One thing that we saw in multifamily that's been really big, over the last, call it 4 years, has been insurance, right? Insurance rates going up, unpredictable. If that was a industrial type property, the tenant would
That's
be
a
on the
tenant's
hook
problem.
yeah,
The tenant
yeah,
has to pay for high insurance.
exactly. So from an investor standpoint, it allows you to control a lot more predictability in what your returns are going to be, which is great. Tell me a little bit about those open air. So, are you guys doing some of the open air retail or open air? You refer to them as open air markets. Tell me a little bit about what that looks like and kind of what that investment is.
Sure. So we just did a deal just a few months ago in August 2025. We did a deal in San Diego. It's an open air shopping called the Headquarters of Seaport. So it's downtown San Diego, absolutely prime location, literally next to the convention center by their Hyatt Hotel. There's multiple other hotels, and a 5 minutes walk, maybe 7 minutes walk to the USS Midway Carrier Museum that sits in San Diego. And it's literally sits on the seaport land. So we bought the shopping plaza, but it's a long-term ground lease with the port. Now,
Okay.
some people are not comfortable with ground leases, but I'm in New York City.
How long is the ground lease on that one?
The lease right now has 27 years left, and the goal is to
Okay.
extend part of the plan, extend it to like 60 years plus. So the port is absolutely open to extend the lease, and that building is a historic building. They can't tear it down. They can't do anything. It's historically protected building. It's a beautiful Spanish style historic building. It used to have a police station many, many years ago. They're literally in the property, they're jail cells. It's like a museum. You can walk in, and we were walking to inspect the property. We were walking into that part of that property where there's jail cells, and there's a mom and a kid walking behind us. And I turned my head and I said, "Look, this is what happens when kids misbehave." I mean it, and the kid laughed.
Right.
Here, if you eat the ice cream, if you eat the wrong ice cream, or my mom tells you don't eat the ice cream, she tells you eat the ice cream and you don't. Here's the
This
place
is where
right
you
there. You
end
don't
up.
have to go far.
Yeah.
So
Oh, that's good.
that's a great property. It's kind of very interesting. It was completely mispriced. Very motivated seller. Seller was again ground lease from the property owner, and the property owner, the port, actually didn't like the seller. They were not investing in their property. They were motivated to get the seller out, and they wanted a new owner with investment to the property. They wanted to drive more traffic, and the property was only 84% occupied. They wanted to lease it up, and port had a percentage lease. The more revenues kind of we got, the port would get a portion of it. So to make the long story short, on that property, port was pushing the seller to find, an exit. They wanted another, ground leasee, and that seller was motivated, and the deal happened at a very high cap rate, 9.25% cap rate in purchase. 9.25% is pretty high.
Yeah.
In that location, downtown, if this was a fee simple, means that the land was owned by the, not the port, but by the owner, it'd be like 5 cap in San Diego, downtown San Diego, maybe 5.5.
For sure. Yeah.
So it was an insane high cap rate deal, which creates immediate cash flow and a margin of safety. And it was only 84% occupied, leaving 16% to lease up. So the deal was essentially closed with fixed rate financing at 6.5%, 10-year fixed, with ability to basically exit after 5 years, all at prepayment penalties burn off after 5 years. So you have a margin of safety immediately. You're 84% occupied. You basically invest in a property. Part of the budget was to pay the port a significant amount of cash for lease extension. Also invest significant amount of capital for property improvement. Even though the property looked actually pretty good, but it could, fresh paint. It was kind of crazy. You go on a property, they have a beautiful courtyard in San Diego, outdoors. The weather is perfect. And they had ripped pillows. It was a kind of crazy. So you just do small set of investments, improvements. You refresh the furniture, you refresh the paint, and you start advertising the place. It's a perfect venue for weddings or any kind of events. Beautiful courtyard. You have a 5 minutes walk to the water. Perfect location. So long story short, it was a unique opportunity, and we don't do volume of this. We did one open air shopping deal this year. We did one multifamily deal this year. We're doing one industrial deal this year. We're looking for great deals, not volume of these deals, in a matter of speaking. Right. So as an investor, that's my philosophy is, you could go look at a lot of deals, pick and choose your battles. And when you find a home run, then you can go, pounce on the ball. So when you feel like you're going to hit the home run, then you go hit it really hard. And that's, we love that deal. So that was an insane. And the crazy part, it was, from a risk reward perspective. So the cash flow from the start, is similar to the industrial. But ton of cash is getting reserved for the improvements so that you push the value higher. So you don't always need to get massive cash flow from day one, even though you could. But you still want to get 6, 7, 8% yield, right? Then you improve the property, you lease up remaining space, and that improves long-term value. And then you look for downside protection. Like every deal we do today, it's like, how can I lose money? I'm a big fan of Charlie Munger. I don't know if you follow what he says. His rule number one is avoid stupidity. Invert, invert. How can you lose money? That's the question. Find a way to lose money. Okay, and then you tell me, and then that's the goal. And you look at a deal like this, and it's hard to find a way to lose money. And you look for downside protection. Rule number one: don't lose money. Rule number two: get an adequate rate of return, and that's the goal. So in an open air shopping like this, when you buy well, the target return kind of almost like you get into the numbers into the very high teens conservatively. It's almost like, really, you can do this. And what's the level of leverage? People say you must have high leverage. No, leverage on the deal is 57%. I looked at it as like, how can it be? Well, when you buy well, even with conservative leverage, you could still get there. That's the secret.
Yeah, no, I love it. That's awesome. And I like that there was a significant amount of money kind of set aside for that lease extension. So was that pre-negotiated as to the level of extension, or was it just that, I guess how did you get that piece of it? Just that they were going to lease anyway to somebody, right? So it's it's not like they want the property back. It's funny how sometimes those land leases get limited. I'm dealing with that on with the university on a property, and they don't want to go above a certain amount, but why would you not if you know you've got a good tenant, and especially you guys are going to have a track record with them, but you've negotiated that there will be some type of an extension, which is going to make the next investor feel very comfortable.
That's part of the plan. So you still have to go, in order to complete the transaction, you have to go to board approval. So the board approved, and it's a process. You're dealing with the board. They have to delay the board meetings. Somebody gets sick. It's a process. So it's not a fast process. You get approved, and they understand you want an extension. They don't want to pre-commit. So what they want to see is, what's your business plan? What are you going to do with the property? And then you show them all the investment and all the improvements. And then they say, yes, you do all these things. We will extend the lease for you. So that lease negotiation on the lease extension is proceeding, but they want to see some progress. So it's not an automatic extension. The property hold period is intended to only 5 years, right?
Right.
So you have a 27-year lease, and even if nothing happens during these 27 years, you'll still make a really good return, even if the port didn't extend the lease.
Right.
But the port is definitely motivated to extend the lease. So long story short, we believe, I'm not going to throw the numbers, but we set aside like $3 million for the port extension. We think they're going to take like 1.5. I mean, ultimately, we have more budget than we think they're going to take to agree to the extension because they're going to see so much value that they will not need as much cash up front, in a matter of speaking. So that's the plan on that property. The other thing is quality of tenant. When you look, just like you underwrite single tenant on industrial, when you look at open air shopping, and this doesn't have a big anchor, so most of the shopping plazas, we look for a great grocer anchor. Like if you have Aldi's or Target or one of those, this is different. This one has actually like a puesto. It's Mexican food, and that place is insanely busy, and it's a West Coast only concept. And they act as almost like a anchor, although it's not an anchor like a national anchor. But they have Starbucks, they have Eddie V's, they have a Cheesecake Factory, they have Brazilian steakhouse, and then they have venue for weddings because Courtyard is beautiful there, and they have an art gallery, a wine bar, ice cream place. So it's a mix of tenants, but you look at, Starbucks is there, you have Cheesecake Factory. Those are long-established brands. And we actually spent 3 days at the property, and we ate at these places. And I have to say this, I was shocked. I lived in America for so many years. I never have gone to a Cheesecake Factory. This was my first time I ate at the Cheesecake Factory. I didn't know what the hell was Cheesecake Factory. I was like, okay, I've heard of that as a very reputable shop, but what do they have? And then my first experience is like they gave me a book this thick, dissertation. That menu is going to kill somebody with that menu.
Yeah.
So
the world's largest menu for sure.
It was hilarious. And then I ordered steak to see for like a $40 steak downtown San Diego. It was even less than $40. I was shocked. It was actually pretty good. I was surprised. So long story short, just, feet in the ground, walking around, having Starbucks like 5 times during the day, going in the morning, at night. We saw this was a good, solid place in the middle of the week when we went, and then weekends, and they run events, and then there's so much potential there that if you run it and manage it more actively, you could really have this thing shine. And people come out to San Diego. Oh, on top of all this, the San Diego port announced an expansion for the cruise terminal, and I think Royal Caribbean is going to have a brand new ship docked, 10 minutes away.
Oh,
so
wow.
all those things are, kind of tailwind.
Yeah, for sure. That's awesome. Oh no, that's been great, and that's just a good lesson for those. Also, the fact that you're going down there, that you're checking out the facility, that you're looking at what else is there, who are the tenants that are in that area. All that stuff helps to make a solid investment decision. So that's awesome that you guys are doing that, Mike. So I want to be respectful of your time. Is there something that we haven't covered that you want the audience to know about TF Management Group and the potential of being able to invest with you?
I appreciate that. We never try to sell anything to anyone. We seek to connect. Folks want to reach out to me. I mean, you have a wonderful podcast. I have a podcast too with a cheesy name, and folks can reach out, and if they're bored, they got nothing else to listen to, they can tune in. From time to time, I have great guests like you on my podcast too. Hopefully you'll come on my podcast. But the point is, we have a lot of interesting characters who come on the podcast. The podcast has a cheesy name, Big Mike Fund Podcast. And the website is bigmikefund.com. And if you misspell it, you forget the D at the end, and you go to bigmikefund.com, I promise it's not a kinky site.
Awesome. That's good. All right, Mike, this has been great. How about, I've got a couple other questions for you. One just deals with investing. What advice would you give somebody who's maybe just starting out in their investment journey?
I would say approach investing with the following question in mind. This is how I always think about this. Are you learning to invest, or are you investing to learn? It's always both. The point is, don't think of investing as a game of perfection. You will make mistakes, but you got to learn. So you need to prepare and do your due diligence to continue to learn before you write a check. But as you write the check, continue to understand what you invested into. You should understand before you invest what you invested into and who you invested with and how it makes money. But as you invested, observe, and try to learn, how does it work? How is it making money? If it hits problems, what kind of problems? So it's an investment journey. The best way to describe it, it's a journey. I have a new book I'm working on. It's going to be an offer to your audience. I'm not selling the book. I don't need anything. I just, if folks go to the website, bigmikefund.com, they sign up. When the book comes out, it'll be available. And the reason I mentioned my own book, for no other reason, it's my second book. It's been many years. This book has been on writing for like 2.5 years. And it's finally coming out. Part of that book, one of the most important chapters, I call it the journey to becoming an extraordinary investor. It's a journey. It's not a instant thing. And I've been humbled many times. I'm a human being. I make mistakes. Nobody's perfect. You will make an investment and it won't go the way you expected, and you lose money or you make less money. Just learn. If you take it this way, and of course, as a beginning investor, always remember the basic rules of diversification. You need to diversify among many, strategies, sectors, who you're investing with, over time. All those things matter. And continue to learn and see who do you like, what jockeys you want to back. If you're investing in real estate, who do you really enjoy working with? But it's not one. It's always got to be enough of these. 3-5 people who you really like with can help you build a diversified portfolios and different strategies. So the final thing I'll say on that question is, it's not ready, aim, fire. It's ready, fire, aim. Yeah. That's the journey. You always do. And then you course correct. And that's the journey. At the end of the day, this is how you, especially if you're young and early, don't be afraid of making a mistake. Even if you lose money, you get a PhD in investing. You learn through experience. And it's kind of funny how it works. Before the show, you asked me about the books, some of the books that I like. And I'll mention one book because it comes to mind because it's applicable. Yeah. Sometimes you win. Sometimes you learn. John Maxwell, one of the greatest writers on business. And the reason I mention this is investment journey is that hopefully you win 9 out of 10, but the one time that you don't win, you lose. Things don't go the way you expect. It's the best time to learn.
I love it. I have not had anybody, I'm a fan of John Maxwell, but I haven't had anybody recommend that book. So I'll have to check that one out myself. That is
a phenomenal
book.
I'm
an Audible guy as well, and I do it on my own. That's on my run. So that should be hopefully tomorrow mornings. So
you'll enjoy the book. I have to say, good book is worth reading multiple times. People ask me what books do I read? And I tell them, listen, the books most of them I listen to, but it's not one time. Sometimes it's 5 times, and because the wisdom of a good book sinks in on the second, third, fourth. It's not about the volume; it's about quality.
I agree. I completely agree. Hey, Mike, this has been fantastic. I appreciate you being a guest on the Wealth Flow, and I think we'll call it a show. Thank you so much.
Thank you, Keith.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love more than anything else to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.